and I'm going to tell you the topic issue of shares in corporate accounting. So let's start with the topic issue of shares. So as the name suggests, issue of shares. So this is the topic related to corporate accounting. So we must know about the corporate. First of all, let's discuss what is company. So company is an artificial person created by law having separate legal identity and a common seal. So as the definition says about it, it is an artificial person. It is not a natural person. So it is an artificial person which is created by law. It is having a separate identity from the shareholders. So because it is an artificial person and it is also having its own identity, so it also carries a common seal as its signature, right? So let's talk about the issue of shares. First, I'll give you a brief about the table of contents. So we are going to discuss in this session meaning of shares and share capital, then categories of various share capital, then types of the shares, then how to raise the capital in the market, then what is the minimum subscription, then accounting for the issue of shares along with the practical problem, and the basic terms which are related to accounting for the issue of shares, that is calls in arrears and calls in advance. So let's start with the meaning of share capital and shares. So company being an artificial person cannot generate its own capital. Because it cannot generate its own capital, so it needs to be raised from somewhere, right? It is collected from the several persons, and these persons who contribute to the capital of the company, these are known as shareholders, and the amount which is contributed by them is called the share capital, right? Now, what is share? Share refers to the unit into which the total capital of the company is divided. And share is evidenced by a share certificate which is issued by the company under its common seal. So each share has a different name. Now let me give you this explanation. Let me explain this this definition with the help of an example. Suppose company issues 10 lakh share capital in the market by issuing 1 lakh shares of rupees 10 each. The shares are 1 lakh, so units are 1 lakh, and the share capital which is to be raised is 10 lakh, because 1 lakh shares of rupees 10 each constitutes 10 lakh as a share capital, right? Now let's talk about the various categories of share capital. Authorized capital. Authorized capital is the maximum amount of capital which a company can raise during its lifetime from the market. So this amount of capital is shown is or reflected in the memorandum of association of the company. Then there is issued capital. Issued capital is part of the authorized capital which is issued to the general public, right? So suppose authorized capital is 10 lakh, but the company issues only 5 lakh out of it to the general public for the subscription. Now subscribed capital is the part of the issued capital. Suppose company has issued 1 lakh capital in the market and the public has subscribed only for 80,000, only for rupees 80,000, right? So that will be a subscribed capital. So here, as I have given you the example of subscribed capital, here the subscribed capital is less than the issued capital because there is under subscription, right? Next is called up capital. So the amount of the capital which has been issued to the general public. Suppose we have issued 1 lakh shares of rupees 10 each to the general public, right? Now, out of the 10 rupee face value, the company has called only rupees 8, right? So that will be 1 lakh multiplied by 8 will be the called up capital. Is that clear? So now let's talk about the paid up capital. Out of the called up money, sometimes it may happen that shareholders have paid up only a part of it. Suppose out of rupees 8, the company which is called from the general public, few shareholders have paid only rupees 6 on the given number of shares, right? So that 6 rupee becomes a paid up capital. Now the uncalled capital. So as we discussed that suppose a share having face value of rupees 10, but the company calls 8 rupees out of that. So the 2 rupees which has not been called yet is called the uncalled capital, which may be called up whenever company requires it, right? Reserve capital. So reserve capital is the capital which can be kept as a reserve for the winding up or for the purposes when the company needs it. Let's talk about it. Suppose it is a portion of the uncalled capital which may be called by the company in the event of winding up, right? So such capital, such amount is called a reserve capital of the company. It is available only for the creditors on winding up of the company. Now let me explain you these categories of share capital with the help of diagrammatic representation or as an example, right? Next slide. Yeah, format in the balance sheet. So the capital, the share capital, how it will be shown in the balance sheet, I'm going to discuss that. Let's discuss this with the help of an example. Sunrise Company Limited, New Delhi has registered its capital as rupees 40 lakh divided into 4 lakh shares of rupees 10 each. The company offered to the public for subscription of 2 lakh shares of rupees 10 each as rupees 2 on application, 3 on allotment, 3 on first call and the balance on final call. Now the company received applications for 2,50,000 shares. The company finalized the allotment on 2 lakh shares and rejected applications for 50,000 shares. The company did not make the final call. Now the company received all the amount except on 2,000 shares. Call money has not been received. The above amount will be shown in the notes to account of the balance sheet of Sunrise Company Limited as follows. So now notes to account. This will be shown in the balance sheet as notes to account, right? After the balance sheet it is done. So share capital, authorized share capital, which is 4 lakh shares of rupees 10 each, that will be shown in the outer column, that is 40 lakh. Then out of the authorized, company has issued only 2 lakh shares to the general public. That issued capital becomes 2 lakh shares of rupees 10 each, that is 20 lakh. Now out of issued subscribed capital, it was overly subscribed, so company had to reject few applications. So now the subscribed and issued will become equal, right? But we have to see whether it is fully paid up or not. So subscribed but not fully paid up. So 2 lakh shares of rupees 10 each becomes 20 lakhs, but out of it company has called only 8 rupees per share. So 2 lakh shares of rupees 10 each, rupees 8 called up. So it becomes 16 lakh, but out of it few shareholders have not paid the money. Like the company received all the amount except 2,000 shares where call money has not been received. So upon these 2,000 shares, the company has not received 3 rupees on the first call. So 2,000 multiplied by 3 becomes 6,000, which is called in arrears. So it will be deducted out of it. So 16 lakh minus 6,000 becomes 15 lakh 94,000. Right? So this is subscribed but not fully paid up capital. Presentation in the balance sheet as a note to accounts. Let's talk about the types of shares. There are two kinds of shares which we are going to discuss: preference shares and equity shares. The preference shares are the shares which have to fulfill the following two conditions. They have a preferential right to the dividend, means whenever dividend will be declared, it will be given to the preference shareholders before it is distributed to equity shareholders, right? Now, they will get either the fixed percentage on the face value, or they will get a fixed rate of, or they will get a fixed amount of dividend, right? Next, they are having the preference over the repayment of capital as well. So whenever the company winds up, it repays its capital back to the shareholder. So it will be paid back first to the preference shareholders, then it will be paid back to the equity shareholders. So preference preferential shareholders are having preferential right over the dividend as well as the repayment of capital. So now let's talk about the equity shares. These are also known as the ordinary shares. They are not having any preferential right over the dividend or the repayment of the capital. So whatever is left out after paying to the preference shareholders as a profit, that will become or that will be belong to the equity shareholders only, right? Equity shareholders also carries voting right. Now let's talk about steps to raise the capital from the market. First of all, prospectus is issued to the general public. As a college invites application for the various courses, so it issues prospectus to the students or it issues prospectus in the market, right? Same way, company issues prospectus to the general public, in which the information about the company is given, about its business, about its future prospects. Everything is mentioned in the prospectus. So now, general public, after getting the prospectus and after reading the information, they may apply, right, to the shares issued by the company which is mentioned in the prospectus. So now, after issuing the prospectus, company will receive the application with the application money. So now the application money will be received from the shareholders or from the general public, and it will be deposited in a prescribed bank. Now, after receiving application money, we'll decide about the allotment of the shares. Sometimes there is oversubscription, so we have to reject few applications. Sometimes there is an undersubscription, then company cannot go or the company cannot proceed with the allotment of the shares. So it must receive at least the minimum subscription. So after receiving the minimum subscription and fulfilling certain formalities, legal formalities, company will proceed with the allotment of the shares. So now when the shares are allotted, company will issue the letter of allotment to the shareholders, right? And after that, company will make calls for the payment of the balance money. Now let's talk about the minimum subscription. So minimum subscription, in the opinion of the directors, must be raised to meet the needs of the business operations of the company relating to, number one, the price of the property purchased or to be purchased. Number two, preliminary expenses payable by the company and any commission which is payable in connection with the issuance of shares. Then, for the payment of the money borrowed by the company for the above two reasons which we have discussed, for the working capital or any other expenditure required for the usual conduct of the business operation. So, company must receive the minimum amount to proceed further, right? It cannot be less than 90% of the issued amount according to SEBI guidelines, right? So to proceed further, company must receive at least 90% of the issued capital. Now, if the company has not received the minimum subscription, then it needs to refund the entire subscription amount, right? And that needs to be refunded within the time. And if a delay occurs beyond 8 days from the date of closure of the subscription list, the company will be liable to pay the amount along with the interest rate of 15%. Is that clear? The point to be considered here it is mentioned 15%, which is not 15% per annum, right? Now let's talk about when the company issues shares, then it can issue shares either at par or premium or the discount. So what does that mean? When the company issues the shares at par, it is called issued price is equal to face value. When the company issues shares at the premium, then issued price is greater than the face value. And when the company issues shares at discount, then issued price is less than the face value. Let me give you an example for this. Suppose the face value is rupees 10. So the company, if it has issued the shares at rupees 10 only, then it is issued at par. But when a company has issued shares for rupees 12, then it has been issued at premium. But if suppose a company has issued shares at rupees 9, then the company has issued it at discount. Got it? Now let's talk about the accounting treatment. So on an application, When you will receive the application money, the journal entry will be passed, that is bank account debit to share application account, right? So all the application money received will be deposited in a bank account and will be credited to the share application account. This account represents to all the shareholders from whom the money has been received. For transfer of the application money, now you need to transfer the application money to the share capital account. So share application account debit to share capital account. Next, suppose if you have received excess application money, then you need to refund it to share application account debit to bank account for the refund amount. Next, for the amount due on allotment, the journal entry will be share allotment account debit to share capital account. Now suppose excess of application money has not been refunded, right, and it has been adjusted against the allotment money, then share application account debit to share allotment account. So now in this case, application money which was in excess has been adjusted against the allotment amount. Now on receipt of the allotment money, the entry will be bank account debit to share allotment account. Is it clear? Then on the calls, entry will be share call account debit for the due, share call account debit to share capital account, and on receipt of the call, the entry will be bank account debit to share call account. Here you need to add the words first call, second call, and the final call along with the call money. Now let's discuss this with the help of an example. Mona Earth Mover Limited decided to issue 12,000 shares of rupees 100 each, payable at rupees 30 on application, 40 on allotment, 20 on first call, and the balance on second and final call. Now, applications were received for 13,000 shares. The director decided to reject application of 1,000 shares and their application money being refunded in full. Now, the allotment money was duly received on all the shares and all the sums due on the calls are received except on 100 shares. Now, you have to record the transactions in the books of Mona Earth Movers. So, how these will be recorded? Let's talk. See, you have received the application money on 13,000 shares and the application money is 30 rupees per share. So the total money will become bank account debit to share application account, that is 13,000 multiplied by 30 rupees per share. So that becomes 3,90,000. So now this money will be transferred to share capital account, but excess money has to be refunded back, right? So 12,000 shares were allotted. So 12,000 multiplied by 30 rupees per share becomes 3,60,000. So share application account debit to share capital account, that is 3,60,000. Now the refunded money will be returned. So journal entry will be there for the same, that is share application account debit to bank account, right? 1,000 shares at the rate of 30 each, 30,000. Next, allotment money becomes due. Share allotment account debit to share capital account. The money due on allotment of 12,000 shares at the rate of 40 per share, 4,80,000. Then bank account debit to share allotment account on receipt of the application allotment money, 4,80,000. Then first call will become due. To share first call account debit to share capital account, 12,000 shares at the rate of 20 per share, the 2,40,000. Next, on receipt of the first call, bank account debit to share first call, right? Yes, so first call money has been received on except 100 shares, right? 100 shares pay you have not received rupees 20 per share. So you need to deduct that 2,000 out of this 2,40,000. So you have received only 2,38,000. Now second call becomes due. Share second and final call account debit to share capital account. 12,000 shares at the rate of 10 per share. That becomes 1,20,000. Then on receipt of the final call money, bank account debit to share first and final call account. Yes, you have received the final call except on 100 shares. So 100 shares multiplied by 10, that becomes 1,000. You have to deduct it from the call money. So that is 1 lakh 20,000 minus 1,000, you have got or you have received from the public 1 lakh 19,000. Yes. Now let me discuss calls in arrears. What is that? Call in arrear means whenever a shareholder fails to pay the amount due on allotment or any of the call. As we have discussed in the previous example, the shareholders have not paid the final call as well as the first call. So that becomes the calls in arrears, right? So this amount will be transferred to the calls in arrears account or the unpaid calls account. For this, company maintains this calls in arrears account, and the journal entry will be like that: calls in arrears account debit to share first call account or to share second call account, right? And when the shareholders makes the payment of calls in arrears, they have to pay the interest as well. So along with the interest, the entry will be bank account debit for receipt of the money to calls in arrears account to interest account, right? Because this interest becomes income to the organization, to the company. So that's why interest has been credited here. Next, there is calls in advance. Sometimes shareholders pay a part or the whole of the amount which has not even been called, right? Suppose on application they have paid even the allotment money, they have paid even the call money, right? So that money received is called the calls in advance. So this money is adjusted against the further calls, right? But because you have received the calls in advance, so you need to pay the interest to the shareholders upon it, right? As you have received interest on calls in arrears, so you need to pay the interest on the calls in advance as well. Now the interest rate can be decided like by the table A of the Companies Act provides for the payment of interest on calls in advance at the rate of not exceeding 6% per annum, right? So the entry will be bank account debit to calls in advance for the amount received on calls in advance. Now on the due date of the call, the amount of the calls in advance will be adjusted by this entry. Calls in advance account debit to particular call, that may be first call, that may be second call, right? Now the balance of the calls in advance account will be shown as a separate item under the title Equity and Liabilities in the company's balance sheet under the head Current Liabilities as subhead Other Current Liabilities, right? It will not be added to the paid up capital. You have to keep it in mind. So thank you class. Thank you for being attentive to the session. If you have any doubts or any problems, please let me know. You can write to me.